The risk is the highest thing here. We're looking at key component. Besides, I would assume also return on investment. Does that come into play as well?
Yeah, well, if you minimize the risk in an acquisition, you're going to increase your ROI for yourself and your investors. I mean, this is all about Warren Buffett, like minimizing risk to the business. Like, I know what I'm working on.
Climbing up is a struggle, tension in the air. But the underdog prevails, we here to declare. To the top or the mountain where champions stand. Failures can't break us, we taking command. Yeah, it's a journey, climb to the peak. Scaling businesses, who it ain't for the weak. Growth is the game, we play it real tall. From the bottom to the summit, we rise, never fall. Interview the legends, success stories told. Risepreneurs, hearts made of gold. Strategies unfold, in the struggle grace. Hardship and challenges, yeah, we still embrace.
Welcome back, everyone, to another show of the Risepreneur Podcast, a show dedicated to all the entrepreneurs and business owners who's looking to grow, scale their businesses. Today, we have a special guest, Jon Stoddard. He is an expert and the founder of DealFlow System. He is an expert in business acquisitions. He's also a podcast host of top M&A Entrepreneurs. And he's also CEO and investor of the Stack Acquisitions, which is focusing on business acquisitions and also helping others acquire their. Jon, say hi.
Hi, Boruch. Thank you. Thanks for having me.
Awesome. Jon, as always, I would love to hear how you got started. I know you've been in the Air Force. Thank you for your service. And can we go back a little in time to review how you started your journey in the corporate career world and got to do what you do today?
Yeah, going way back because I'm an older guy now, going way back. I think like my first acquisition when I was a kid in a small town called Wilcox, Arizona. I bought a calf at an auction for about $90, put the cash down and then waited 3 years, put it in the herd. My parents had a small herd and sold it for $2,000 3 years later. Those things grow real fast. I didn't know at the time that my dad covered all the expenses of feed, water, and veterinary kind of stuff. So I was oblivious to that. That was my first acquisition. Second one was I bought this car. It was an old, like a Chevrolet Vega for $500. I fixed it up, put a couple things on it and sold it for $1,200 in a short period of time too. So it's like, that's where the bug caught. Now, after that, I kind of went a wayward around, went in the Air Force because that's what my dad did. That's what my brother did. And then I got out of the Air Force, went into engineering at Northern Arizona University, got a degree in engineering, and then spent probably 20, 25 years working at small software companies and big software companies. One was a small company, was Digimation, pretty like 20 people. And then I worked at Intuit, Autodesk, and some other little ones like that. So, and we also did a startup called TurboSquid out of Digimation. We said, hey, let's get into this 2001 crazy.com stuff and start a company. And TurboSquid was a 3D asset supplier for visual animation artists. And we raised some capital from Intel and Kodak at the time. Kodak tagged along. And Advantage Capital. And they put $5 million in our business. And then many years later, that product was sold to, the company was sold to Shutterstock. So that's kind of a wayward around. And then I got back into M&A work just a couple years ago and said, hey, this is something I started with. Kind of went all the way around the world and came back to M&A and teaching M&A and learning more about it and doing the podcast. So that's where we're at.
Awesome. So from a get-go, you were kind of entrepreneurial. Was it your ideas with those startups? You said we.
No, it was me. I mean, my dad was my dad, humble beginnings. Like he didn't even graduate high school and he was in the Air Force for 23 years. He had no entrepreneurial bug about him, but my mom's dad did. He owned a Cadillac car dealership early on in his life and ran that for 20, 30 years. So I kind of got the bug from him, I think.
So how did you follow both worlds? Like I know back then and even now still there's a lot of pressure to go to college and climb the corporate ladder. I'm just curious how you came to that transition. You know what, corporate stuff is not for me.
Yeah, I just got, well, aside from getting laid off 3 times in the tech world, that kind of pushes you out the door. So like the first time you figure out, maybe you go, and then you come back in, and the second time you come back in, because there's so many tech companies you can get hired at. And then the third time goes like, I'm done. 3 strikes, you're out. I'm running my own business. I'm going to do it myself. I don't care. Whatever it takes, I'm going to make this work.
Awesome. So they pushed you out of there.
Yeah.
You've meant for something greater.
How many times does somebody have to hit me in the head? Yeah.
Cool stuff. All right, so Jon, then let's dive into the world of acquisitions. And again, as I mentioned to you earlier, what got my interest and how I came across your podcast and guests that you were interviewing is growth through acquisitions, right? So I was looking into company and opening new locations, and then I found that, wait a second, there's actually faster growth that could be in place in terms of capitalization of the company through acquiring competitors, acquiring something that complements, right, strategic buying and all that stuff. So what's your take on that? Can you bring us into that scenario, like what the possibilities are?
Well, I would have to compare doing a startup, which I worked on many times. It's a frustrating, long journey that really the odds are against you. It's like trying to build a plane on the runway and get it flying and get it approved by FAA and get the engine working, get the plane, everything working. It's just so much more difficult than compared to buying a company that's already throwing off revenue, already has a process in place, already has customers in place, already has a customer list in place. It's so much easier. The only challenge is like, what are the skills required to purchase that cash flowing machine? That's what you have to work on. My chance of success if a business has been around for 10 years, that'll be around for another 10 years, is better than this startup. I mean, I've worked on startups. I've helped raise startups. The failure rate so high. Getting funding is so low. The possibilities, it's like less than 1% to getting raising money from a VC or somebody else. Focus your energy. Find a good business, not a turnaround. Some people love those things, but finding a good business and just learn how to get the deal flow, review the deal, see if it's a good deal. Can it handle the financing to purchase the business and buy the business, secure the funding? Because there's a lot of places out there that'll do it for you. Help you raise the money.
I look at businesses like when you mention stages, a startup, it's like a newborn, right? The newborn at the higher risk to possibly end the life of the baby, right? Because they're not independent at all, like teenagers or somebody who's an adult, right? Then they transition to a toddler, transition to a teenager, and ultimately an adult who is responsible for their own action and have a higher survival rate, right, than somebody who's a newborn. So you mentioned 10 years. Is that one of the measuring sticks? Like, what else do you look at besides the age, right? Business can be 10 years, but that's something that somebody does as a self-employed, and they're not really looking at their cash flow constantly growing. Like, what other things that you look at besides age?
Well, it's a type of product that they offer. Is it an essential service or product? I don't really get into buying businesses that are trends or small things. There's some other risk factors that will come back to bite you. I'll give you a perfect example. Just recently, you mentioned that I was Stonehouse Ventures or Stack Ventures. I'm actually part of a group called Patriot Growth Capital. It's a mini PE firm. We're buying e-commerce companies. So we looked at a company that built screens, aftermarket replacement screens for cars. And it was throwing off $1.5 million in EBITDA for the business. And it's been running over 5 years. I said, okay, the risk factor has gone down, the revenue's up, he's got the process and the system's worked out. But we asked him, okay, who did you supply these aftermarket screens for? Oh, just one kind of car. One car. Too high customer concentration risk. So that's one negative against it. The second thing is, okay, tell me now, where do the screens come from? They come from China. Do you speak Chinese? No, but I worked with engineers. Are you a touchscreen engineer? Yeah, I've been doing it for 20 years. So there's a key man risk there that we had to kill it. We could not put a CEO in that role if he didn't know anything about touchscreens. It's just not going to work. So I played this game called Pass or Pursue. That's a pass. Yeah.
Okay, so what I heard besides age is the product, then concentration of the customers, and then also you're looking at the key man. So in some way, then he's also in a position where he did not really remove himself, right? So he has a job in there. So that could be a red flag for somebody who's acquiring a business and they're not really an expert in or not holding I would not say license. Like I'll give an example, right? Let's say a plumber who's looking to expand. So him being a plumber, it's easy for him to go and acquire a competitor because he knows everything about the plumbing. But if somebody purchased a company, they're not really in that space. When they're looking to buy something like that, they kind of removing themselves from possibly getting funding or investors not having a doubt that there's a risk.
Yeah,
so
absolutely.
So the risk is the highest thing here we're looking at as a key component. Besides, I would assume also return on investment. Does that come into play as well?
Yeah, well, if you minimize the risk in an acquisition, you're going to increase your ROI for yourself and your investors. I mean, this is all about Warren Buffett, like minimizing risk in the business. Like, I know what I'm working on. Let me give you another example. I have a coaching student that was looking at a trucking company. And I said, Scott, tell me a little bit about your trucking experience. I go, 0. I go, well, you're either going to screw the business up, but also you're not going to get a loan from any lender because they're just going to see you as a huge risk. You're going to screw the business up and they're not going to get paid back. So why are you even chasing this? Right? You got to bring some expertise to the business.
Yeah, makes sense. You mentioned a loan. I'm thinking, can loan be leverage? I mean, not necessarily going for the loan, even if you have a different source of funding and able to just acquire it. Using a loan, a bank to scrutinize the business because they probably have their list of things that they look at to qualify business. If business is not qualified for the loan, most likely it's a high risk.
Yeah, it's a high risk situation. They're not going to do it. If they're not going to do it, you should not either. Listen to what they're telling you.
So that would be probably one of the things to reach while, not being that experienced in business acquisitions to see if the business actually has a risk level.
Yeah. I mean, look at most of the businesses you go purchase today. If you're going to go buy an HVAC company, it's 10 years old. It's throwing off, $5 million and $1 million EBITDA. You're going to look for the link of the business, and then what you're going to do is purchase it or leverage it, LBO it, right? Maybe up to 90%, maybe 70%, but you're going to borrow money to purchase the business. You just got to make sure the cash flow can support the debt payments, right? And now, in the United States, we're fortunate to have this SBA, Small Business Association, 7A loans. They're going to give you a loan to buy the business because they want that transfer of wealth from one citizen to the next citizen. But they're going to put, you're going to say, hey, I just found a great business, 10 years old, it's doing $5 million, $2 million EBITDA. I need to borrow money to buy that. They're going to put that through underwriting, which means they're going to put it through debt stress test and all types of buy box, make sure it passes their underwriting before they give you that loan. Yeah, there's a whole process to do this. And you got to use the SBA to help you qualify the business. Is it an up or down business you want to buy?
Is there limitations with SBA, meaning the total amount that they would be willing to fund?
Yeah, it's $5 million in a 10-year period.
So 5 million, 10-year period. And okay. And they probably look at the strength of the business to make sure that the whatever business is producing is able to cover the operations plus paying all that principal interest.
I mean, the debt's going to be for 10 years. So they want to make sure that they get paid back, right? So they want to make sure that there's a track record there of, for the next 10 years, you owe us $300,000 a year. Can you pay that back? Right? They're going to want to look for the strength of the business.
Yeah. What's the difference between going the SBA route or getting money from the investors? Is it strictly the interest?
Yeah, well, the interest rate, unfortunately, right now is kind of high. It's 11 point something, but if you add on closing costs and everything, all the other costs, it's kind of getting about 12%. So it's double digits to buy a business. Now that affects cash flow. It could, like, $1 million loan could add another $20,000 on debt payments for that year for $1 million business. Now, debt is a double-edged sword, right? Debt's great. It's better to pay interest than taxes. But if your business hits a snag or, a hiccup there, you want to see, can you handle those debt payments if sales drop 15, 30%? You have to put it through a debt stress test. Warren Buffett is famous for saying you can see what people are wearing when the tide goes up.
Yeah, that's a good one.
Yeah.
Yeah. So speaking of that, I've seen on your LinkedIn somewhere that you mentioned that one of the purchases you made did not turn out to be good. Was that on yours? I think I said
Yeah.
yours.
That's I bought a cool coaching course company. I paid like six figures for it, and this is one of my first purchases by myself, by my ego-driven self, and bought it and realized that the customer concentration or the source of leads came from one source. And 6 months into the business, the place where I was advertising on changed their ad policy and then pretty much killed the business. So I had to shut it down. That's one of those hard lessons you learn. Not all acquisitions turn out. And also, usually it's good to have another coach or a point of view to see what you're not seeing. Because sometimes you get this ego-driven, I got to get this deal done, and you don't see the problems in the business.
That's a good one. I actually have a friend who purchased a pizzeria, and it was so good that he opened 2 more. And within 6 months or so, he ended up closing all 3. So in the first one where he was successful, just happened to be the location was the reason. Basically, sometimes you hit the trend and it's happening and you think that, I've been successful in one, I'll just do another one and another one. Just like entrepreneurs, right? They exit one business and they think they just can easily start another one and have the same exit, but it's not necessarily the same traction they might get because all of these variables that come into play that they did not anticipate or did not think of. So for sure, having somebody like yourself who would evaluate, and you with your students constantly evaluating different opportunities out there and seeing, dissecting each deal and see what's right, what's wrong.
Yeah. First of all, on that business right there, I don't encourage anybody in my coaching to ever go into restaurant or the food business. The failure rate is so high. It's upside down. I mean, it's probably 96% failure rate. I have a friend that used to be a bankruptcy attorney and said, he said 100% of my business comes from people trying to buy a restaurant or start a restaurant.
That's crazy.
That is just something I would never go into, by the way. Yeah.
And you see them everywhere on the Biz Buy Sell or approach any broker.
It's just so fickle. It's so trendy. I mean, there's so many red flags that come in. You're like, maybe in a franchise, there's some kind of systems in place and the process and consistent revenue. But if you do something different, the people in your area age out and not like that type of food anymore and then move. Or, in a macro level, people move out to a different section of the town. It just changes. So it's too fickle. Yeah.
That brings to mind one of my coaches shared with me this awareness where he asked me basically, if your son would go for the first time to Las Vegas and sits at the blackjack table and basically cleans the house, would you be happy for him? And I was like, yeah, why not? It's a good thing to win. He's like, this is opposite of what you should be thinking. I'm like, what do you mean? So he said that it's just a matter of time when the house wins and takes everything back, right? So you basically allowing your son to celebrate luck that basically positions him to be so cocky and too confident to go and think that he always can beat the odds. Right. So, and examples he gave me that when you go into a partnership, into a business, without clearly defining things, brothers, family members get into arguments and don't talk for years, right? So most of the time, those relationships never work out. So what makes you think that you can go and actually beat the odds? So that thought actually made me think about, because I was involved in too many startups, and of course, most of them failed.
Yeah, it's a
and
disease.
But every time we go into it, it's like, I'm gonna be that
I'm
4%
gonna be a
that would make
billionaire.
it. Yeah,
I'm
I'm
gonna
gonna.
unicorn. Let's go. Let's go.
Yes, exactly. Then 2-3 years
Yeah.
later, like, I wasted another 2-3 years.
Yeah.
So here, when one buys a business, gotta be so careful to make sure that the risk level, the odds are on a completely opposite spectrum, right? So instead of having a 4% success rate, go to the other side.
Go to the 96.
96
Flip
of
the
being.
pyramid upside down.
Yes. Can you, so another one, basically, I heard not just customer concentration, you also looked at on the advertisement side, right? The distribution channel that brought you traffic, you got to make sure that it's also not just from one source, because if that source is removed, you're basically done.
Yeah. That's, where you get your leads from, where that comes from. The bigger you get, the more process that's established, right? How customer acquisition system. What does that look like, right? If you're buying a business and it's doing $1 million and it's run by one guy, and the guy says, well, we don't do any advertising. Well, that's a big risk, right? Because it's either probably him walking around a Rotary Club, Kiwanis Club, or promoting himself and bringing it in that you can't replicate if you took it over, right? What minimizes the risk is, as he said, well, we spend, on local ads here, we spend PPC here, and we spend 25% ad budget here, and every dollar we bring in, we get $3 back. Fantastic. Clearly defined system. I spend $1, I get $3 back. Then you ask, okay, take it one little different. It's like, why wouldn't you spend $2 to see if you can get $6 back? You have to test that yourself. Maybe he just said, look, I'm making $500,000 a year out of $1 million business. I don't need any more. I'm tapped out. I put my kids through college. I got a nice house, got a nice car. We take vacations. I don't need any more. I don't want to hire any more people. So that's kind of questions you have to ask, but you got to look for the risk of where those customer acquisitions are coming from.
Jon, can we touch on a topic of the valuation of the company? Only recently I found out that it's not always 2-3x multiple for the business. As business shifts through higher profits, the ratio starts to change for the multiples.
Yeah.
Can
That's a
we touch on that?
complex topic.
Complex?
Because there's a lot of ways to value a business, their book value, and that's the asset value of the business. And there's a multiple of sales, but you don't really see that very often. You see it sometimes in SaaS and technology companies and accounting companies for some reason. And then there's a simple way, and the easiest way, in which most people do it in the SMB world, is a multiple of EBITDA or net income.
Mm-hmm.
And everybody wants to sell their business for 5x in the SMB world, but it's usually not sold like that type of multiple expansion. It's usually 2 to 3, maybe 4.
And does it matter where they are? Like, I've been looking at businesses, right? And business makes 300 in SDE. It's not really beta, right? So, but they want 12 multiples. I'm like, how in the world do you come up with this ratio? What do you have in your business that you would want? When you look at their assets, it looks like ordinary business. There's nothing crazy. So how in the world some companies price businesses at such a high valuation versus when you look at the majority, anything under $1 million, it's usually around 3 multiples.
Yeah, there's a number of scenarios where that may what happen. One is like he thinks his business is worth that because he spent the last 2 years building the business, and that's what everybody else is selling it for. That's what he sees, and then he's going to go try to sell it. He may get slapped in the face after a little time, say that's not what businesses are selling for. And I'll give you a perfect example of that. I know the CEO of Flippa. They sell thousands of business. They have 300,000 people on their email list. And the average multiple that's sold on their site is between 1 and 3x. I'm talking about software companies, app companies, YouTube channels, e-commerce companies. So what he thinks and what reality really is are two completely different things. He's not a motivated seller. He's just somebody that thinks I'm going to sell because everybody else is doing that.
Made me think of real estate. So just because somebody wants certain amount for their house, it does not mean that's what the market will pay for it. They're going to look at the comparables in the area and evaluate. So yeah, you can ask for whatever you want, but then you're going to sit there and wait forever for a buyer to show up and actually consider.
If you live in a neighborhood and the comps are $300,000 for your house and you're trying to sell it for $600,000, you got a pool. That's just not going to work. They're not going to pay, $300,000 just for a pool. They'll put in for $25,000, $50,000. It's just not going to work, right? Now, however, there's possible differences in that, because if they got a great IT firm or an MSP firm and there's a strategic buyer who says, I love their customer list, I'm going to just buy it for 12x because then I could start selling my products right to their customer list, and they paid off that business in the first quarter or first year of the business, that's different, right? But if they're not getting those offers, that's not really what the business is worth to you. You have to stay disciplined about how much you spend. You got to be a disciplined buyer.
Yeah, not get too emotional and too attached.
Yeah, there's a great book out, Barbarians at the Gate, where they're, two groups of buyers are trying to buy RJR, and they just keep, building up the price, competing offers, and, they destroy the company with too much debt.
Interesting. So, Jon, then another topic that I want to touch on is financing, right? So it's not always just straightforward, here's cash, or you know what, I'm going to find a down payment, the rest SBA will cover, or it will be a combination of down payment, SBA, and maybe investors. I found out about concepts of seller financing and other creative deals. Can you touch on some of the approaches that not straightforward, that would make people aware that there's ways to acquire businesses that would make it much easier for them to get in and minimize the risk?
Yeah. So let me just talk about seller financing. There's a lot of people out there, coaches say, hey, go buy a business with seller financing, 100% seller financing. That's really a myth. It just doesn't happen, right? Do you really think that I could walk up to a guy that owns a $5 million HVAC company and say, hey, Mr. HVAC company, I want to buy your business, but I want to use seller financing. So wait a minute, you want me to be the bank and give you all the revenue? That doesn't happen, right? There are times when it does happen. For instance, the individual that wants to buy the business is in the business like a general manager, and the seller wants to retire, and he'll finance that because he knows he could take good care of the business for the years. Or another scenario, and you and I are on podcast, and we learn when we interview people that have done 10 times more than us, we learn a few skills and tricks and trades of the business. I know a guy that started with 4 Midas locations and now is at over 30. And he only offers, because he is much bigger and his balance sheet's much bigger, he can go to a single individual Midas and say, hey, I want to buy your business. We're going to turn it around, and I want 100% seller financing. That's how you do it. That's like being the house and you're going to win. There's not a lot of cases where some individual doesn't own any assets, no balance sheet, no money, whatever, can go in and buy a business for 100% seller financing. Usually the other case is that it's a crappy business and it's not making money. Sure, take it over, right? It's a turnaround. You take the risk.
So the seller has to be extremely motivated for whatever reason, and also
extremely motivated. Yeah.
Yes, and also really trust that you're not going to destroy the business.
Yeah, exactly. How am I going to get paid if you screw it up in 2 years, right?
Yes, because then, and I've heard stories where the business was sold and only to find out later that the original seller had to go and buy back and take over the operations again because the new owner couldn't handle it.
Yeah, usually that's in the contract. Like, you screw it up or sales start going down, you got to turn it back over.
But
And most of the times, like a guy that's 75 and selling an HVAC business, he doesn't want to take over the business. So that's just a risk. You don't really, if you have a good business and you put it through an investment banker or broker, you're going to get 10 offers with 20% cash down, 50% cash down. And this offer over here, 100% seller financing, throw it out the door.
yeah. So how would the one position it where seller would be open to the idea, like maybe not the 100%, I don't know, 30%, 20%, 10%, 50%, like when, at which point they start to, because then my understanding is when a buyer has some of it as a seller finance, in some way he's protecting himself, that the due diligence and whatever they found in the beginning would be more accurate. And if there's any misinformation or miscommunication that happened, that seller financing kind of covers the buyer.
Well, you're talking about two different scenarios. If I'm going to buy your business, I'm probably going to purchase it with some kind of equity and debt, 80% of that business, and then give the seller 20% seller financing. That gets him to stay around. He could share his knowledge over the next couple of years, and he could stay involved in the business. That's one scenario. The other scenario is, and I always say this, if you're not bringing equity and debt and purchasing a big portion of the business, there will always be an exchange of equal or greater value. For instance, like Ryan Reynolds, Rihanna, or I bring 100 million followers, or I'm a marketing guru, right? I can come in and say, look, I love what you're doing. I'd love to buy your business, and I will 10x it because I have 100 million followers. There will always be an exchange of equal, unless the guy's, unless the guy's like dying and just wants to get rid of it, which is not very frequently, there will always be an equal or greater exchange of value.
Got it. Yeah. Makes sense. Can you share some scenarios that, without revealing the names, but the scenarios of what would, it's also probably not black and white, but scenarios of like, how would you position an acquisition where the buyer would be protected, the seller would be protected, and it would be a typical structure of the deal?
Well, I would get away from just focusing on seller financing. Really, it's a myth. It does happen, but it's pretty rare. What you really need to focus on is building a strong buying team, which is I'm either going to bring my money or I'm going to have the ability to go raise the money to purchase a business. And if I saw a $5 million business that's throwing off $2 million EBITDA, fantastic. That's a great 10-year-old business. I'm going to go find out how to buy it. I'm going to go, talk to the owner and say, are you interested in selling to me? Right. And then you're going to go, can you buy it? Yeah. Can you raise the financing to buy it? Right. So I'm going to have to go raise probably $1 million in equity and then go borrow the debt for the most of it. So I got to be qualified SBA, and I have to reach out to investors because I don't have $1 million in my bank account. Right. I got to do that. If I send an LOI, he signs it, I have 90 days to be able to raise that cash, right? So if you're a seller and you look for people, who want to buy your business, does that person buying the business, is he qualified to run the business? Is he going to screw up the business? And can he raise the capital to purchase the business?
Mm-hmm.
That's the skills you should focus on, not like, oh, you know what, if I just have a more persuasive, conversation with the seller to offer seller financing to buy the business, that'll happen. Look, it's rare, but you should focus on the pyramid where you can buy.
So can you suggest a way to put together such a buying team, like where one would go look to put together such a team, right? Because, let's say I'm an expert. Nobody knows about me though, right? So how do I go and bring teammates that would kind of back me up and be part of my team in pursuing this?
Yeah, that's kind of what my coaching program does. We talk about, and the first thing I talk to all my coaching students is say, go out and start looking for good deals that are, age appropriate, cash flow appropriate, profit appropriate. It's a good business. Right? Go find the deal. That's just first part of it. Now send out, if the guy's a motivated seller, send out a LOI and see if he signs it, right? That's a whole process right there. Once you have that momentum, it's like going downhill. It's a lot easier to raise money to purchase a very strong cash flowing business than if you're way over here and just, oh, you know what? I want to put a board together. I want to put all my friends together, my advisors together. No, go get DealFlow, go find a good business, put an LOI on it. It's going to be a lot easier to raise the capital to purchase that business.
So you're saying 90 days is enough to get the financing and that whole team together?
Yeah, usually it is, man. We could, there's two ways, portion of the business is going to be equity, portion of the business is going to be debt. You're so simultaneously going to be reaching out to accredited investors that can help with the equity portion. And they're everywhere today. There's a lot of different sources out there right now that said that are individuals that are accredited investors goes, you know what? I want to put $50,000 down or $100,000 down, helping you buy this business. This is what I want in return. But there's a ton of them out there because it's the internet. There's millions of them out there. And then there's the SBA. Simultaneously, you're going to go to the SBA, get approved for that, and get your loan documents or your loan number to be able to buy a portion of that business. So that's all out there. It's putting that capital team together.
So what usually investors want for their investment? Do they want portion of the company, or do they want just return on investment for a certain period of time?
Well, it's usually both, right? I mean, it's a $5 million business and I put, $2 million or $200,000 down, I want a slice of that pie. And that slice of that pie is going to throw off dividends or some kind of cash flow. So I get some kind of return on investment.
Okay. So assuming that the business stays the same or grows, that's based on that valuation, this much attributed to that investor, and that's what that investor will be getting for as long as business is. So it's not really a loan; it's an investment, and they
could
actually
be either way, right? But
But typically, what happens typically?
Yeah, so you don't really want to ask for a loan because, again, too much debt on a business can kill the business, right? If you go get equity, they're going to ask for some kind of dividend or distribution from that slice of the pie they own, right?
Okay.
You can say, no, I'm just going to take over the business in the first 12 months. I'm going to halt distributions until, I get my feet solid on the ground. I know how to run this ship. And they go, oh, great, that's fine. Start distributions after 12 months. They're going to ask for some kind of return, right? It could be 20, it could be 30%. What you're seeing today is a lot of private equity people, a lot of investment bankers moving down and saying, yes, I'd like to put $200,000 in your business. And they're going to ask for some kind of IRR, 30% or step up or something like that. And they're going to expect you to, in 5 years, either sell to a bigger guy so that they can make a return on their capital, or they're going to ask for you to buy back their little slice of the pie.
Yeah, so you'll
There's
have
a lot
pressure.
of ways to do that. Yeah.
There'll be pressure because 5 years, that's not necessarily, because you still have that loan from the SBA that you have to deal with. And if your business has to be, like you said, there's no hiccups that you would be in a position to buy back.
Yeah, that's a good point. It's a surgically implanted cancer, right? You've got this guy wants to buy back and all his shares in 5 years. That's a good slice of the pie, right? So you either have to grow the business a certain amount, right? Or go into more debt. And sometimes you got to really think about beforehand before you send that out to an investor and say, hey, please send me $300,000 so I can buy this business.
Yeah. Jon, what happens if, like SBA, I'm also assuming it's not that simple to get SBA, $4 million in SBA loan, let's say not approved. What's the game plan then? Is there a way to raise the rest of the capital, or it's a no-go and you're going to have to find somebody else to represent the deal?
Well, all deals, if it's a good deal and you're moving for it, has to be financeable, right? SBA is kind of the guardrails, right? You're gonna do your analysis of business and say this is a good deal. It can be financed. There's a debt service coverage ratio of 2 or greater. Let's move that deal and all the tax returns, the financial report cards over to the SBA bank to do underwriting to see if it can handle the debt, any stress test, et cetera, like that. They're the guardrails.
Yeah.
They're going to come back and say, we'll give you 90% of the loan, the value of the business, or we'll give you 70%.
And you go
Right?
raise the rest.
Yeah. And you got to go raise the rest, or it could be seller keeps 19% or 20%.
Let's say business is qualified. It's all good there. It's a debt to coverage ratio like 2 and above, and all this is good. Now, the challenge is the individual that is trying to get the financing. He's not qualified.
Well, you're
How
not going
often
to
do
go
you
through
see
that
that?
process, right? He's got to be qualified. He's got to have certain, number of assets on his balance sheet, personal balance sheet. He has to have a credit score, show his trustworthiness to paying back any kind of debt. If he got a crappy one below, I think it's 670. If he's below that, you're just not going to get an SBA loan. You're going to have to bring somebody else on to get the loan and run the business.
How often that happens? I mean, majority of business, my also assumption, it's not easy to find such a business that has 2 million and EBITDA that would be selling for 5 million, right? Majority of the businesses that can be easily found easier, they're usually under 1 million in profits, right? So would you recommend someone to go for a smaller business? If does SBA look at the size of a business to see what the person would be qualified for?
Yes. They're going to look at the size of the business, because usually tells, the smaller businesses, they don't survive after 5 years. A little bit bigger businesses, the likelihood of them surviving, the first 10 years means they're going to go to the next 10 years. That's a risk tolerance of the bank. Usually it's like a national one or a local one. If it's a local one, they're going to look at how long has the business been around. Right? Smaller businesses just go in and out of business all the time. And there's a lot of risk. There's a lot of key man risk. There's no processes in place. The revenue fluctuates quite a bit. A lot of risk in a smaller business. Sometimes it just makes more sense, common sense, to just go after a little bit bigger business.
Yeah. Got it. How often do you see in your groups of students that the business was not purchased, or like how easy it was to find a replacement because personal finances were not good enough for bank to be convinced to go ahead and move forward? Is it easy to find somebody who would represent and take
no, that's
that
not
burden?
easy, right? Not unless you have that set up in front end. I mean, if you find a great business, you put in your LOI, finding somebody in 90 days to say, hey, could you take out this $5 million loan, sign a personal guarantee, and run the business? That's kind of wasting your time.
Yeah. So that's what I was asking, like how easy it is for someone to step in. And then also like another combination, let's say I own a pest control company and I identified the competitors and started talking to them and found a few of them would be interested in transitioning it to me. Right. So if my finances are not in place to get them, then just got to find other creative ways or just be patient and build up.
There's kind of a certain situations like that. If you own a pest control business throwing off $2 million a year top line and, maybe 20% EBITDA, and then you want to go buy a competitor, SBA banks love that. They'll give you 100% of that loan, acquisition loan, to go buy a competitor.
Yeah, but you're not on that level yet. Yeah, but if you're not on that level yet, right? Let's say you're in under $1 million in revenue, not even in profits. Let's say you're at 300, 400 in profits. You're not that caliber of a business that has over 2 million in EBITDA that shows the track record and everything.
Yeah, well, you're going to probably have to get creative financing, right? Have a relationship with a seller that says, I want out of the pest control business. Okay, look, I can't get an SBA loan because my credit score sucks. You want to get out of the business. Let's work together to figure out how I can buy this business. Okay. What do you really need, right? Do you want 1 million in the bank account right now after you sell it? Or can I just send you 200,000 a year for 5 years?
Got it. So isn't that like seller
financing, right? That's 100% seller financing, but you're already in the industry.
Okay, I see.
Yeah.
So you're already kind of showing them that I'm not coming in brand new. The risk level is much lower because I'm in the same space as you are, actually in the same area.
Yeah. Well, why would he do it if you have a lower profit, margin than he does, right? If you got $1 million business and you're only doing 10% profit, like, why would this guy sell to you if he's got $1 million business and 20% profit? You're not bringing anything to the business. But if you got a $1 million business, pest control business, and is throwing 30% profit off, he goes, yeah, that sounds great. He could probably buy me back and accelerate the payments to buy me out.
Got it.
Yeah.
So you got to have a story behind you to.
You got to have a good story, right?
Got it.
There will always be an equal or greater exchange of value.
Awesome. Yeah, that's a really good point. Equal or better. So, anything that business owners should be aware? Like, why would one would want to sign up to your coaching program and get assistance with the acquisitions?
Yeah, what I show people is if you're stuck out there, you're wandering around trying to figure out what a good business is, bad business is, you have to start out with deal flow. You need abundant deal flow. You need to be looking at about like 1,000 deals to know what good is, right? And know what bad is, because most of the deals will be bad. And you need to move past the bad deals as fast as possible to find a good deal. But deal review, the second part of the business is, need to know the language of business, which is accounting. You need to know what an income statement is, 3 to 5 years of income statements, be able to look at all three of those together. And are they improving or, getting worse? You also need to know what a balance sheet is, cash flow statement is. You need to be able to read these statements and tell a good story about this. Where's this guy doing? Is he doing a good job of turning assets into cash flow? And then deal financing, right? Do I know where to get bank loans? That's pretty easy. SBA does that. But I'm going to need $500,000 in equity from accredited investors to go find that, to go buy this multi-million-dollar business. That is a skill in itself. I used to do this for raising money for public companies, and I did it raising money for startups. So it's not an easy process. There's a lot of no's. You just can't fall in love with good deals. You can't fall in love with investors. You just, to make this happen, you need somebody with a point of view that's done it before.
So, and all these three areas is being touched on in your coaching program.
Absolutely. Deal flow, deal review, deal financing.
Would you say deal flow is the hardest one?
Well, I've kind of put some things in place with deal flow. Deal flow is, yes, difficult because there's two types of deal flow. There's on market, which is going through all the broker sites, right? And they're doing all the legwork for you, but they don't deliver enough of the deal flow to you. You just can't wait around for some broker say, oh, I got this deal, right? You may not talk to him for 3 or 4 weeks. You need off-market deal flow too, right? Off-market deal flow is reaching out to unmotivated sellers. And you just have to be in the right place at the right time to cultivate when they want to sell. And there's a couple of ways to do that. One, you could reach out with an email or mail or something like that, or through centers of influence, which is, wealth managers, accountants, or attorneys, or networking groups. So there's 2 ways to do that, and I'll teach you both how to do that. Yeah.
In there. Perfect.
Yeah.
Awesome. So, Jon, how would you want people to reach out to you to dive in deeper?
Yeah. If you just want to have a conversation, reach out to me on LinkedIn. That's how Boruch got in touch with me here.
Yeah.
If you're more interested in what I offer, go to DealFlowSystem.net. If you really want to learn about, people that attend 10 times that I have and 10 times that you're doing right now, go to my website, my YouTube channel, which is Top M&A Entrepreneurs. I've got 700 videos up there talking to CEOs that have done billions of dollars to millions of dollars in acquisitions.
Yes, I've seen already a bunch of them, and they're extremely inspiring and eye-opening. There's so much we do not know as entrepreneurs, just being stuck at being too close to our own business and not realizing what's available to us if we would just step back and look at the acquisition world.
That's right.
Very fascinating.
Yeah. I just don't think there's anywhere faster way to get wealth and independence than, and I've tried it. I've tried the startup route, right? Than going buying a business.
Yes. Awesome. Thank you, Jon, for joining us at the session. It was refreshing to hear of possible ways. And I will include all those links below this video, and we'll go from there.
Thanks, Baruch.
Thank you. Be blessed.
Thanks.